Good morning, everyone. This is Morgan Hill, CEO and founder of Hill and Hill Financial. It's Monday, September 22nd, 2025 at about 8:15 a.m. Eastern Standard Time, coming to you with our monthly economic update. We're going to talk about the Federal Reserve here for just a second. You see on this first slide, the Fed funds rate. Let me just kind of back up for 1 second. Let's just talk about the Federal Reserve. First of all, as we take a look and you see the headlines, there are really two things that we might hear. One is about fiscal policy, which is about how the government will tax and spend. And then you hear about this thing called monetary policy. And this really deals with the Fed and a person whose name we probably know, Jerome Powell, who's the chairman of the Federal Reserve. Now, the Federal Reserve does one thing. They control the supply of money. They really want two objectives to be achieved. One is to maintain inflation, and they've always historically targeted around 2%. And they want to make sure that they optimize employment. And so, again, they will raise and lower rates in order to accomplish that objective. What we've been seeing is a gradual trend towards lowering of interest rates. So, the first thing that I want to just talk about is why is the Fed cutting rates versus kind of the when and the how. The first thing of why I believe that the Fed is cutting rates really deals more with um, they're moving from the rapid rise of interest rates over the last few years, especially during those COVID years, to their gradual trend in order to just lower rates, not due to an emergency. See, sometimes you'll see the Fed say, hey, listen, we're in economic trouble. We have to cut rates in order to spur growth. What's happening now is more of a trend that started about a year ago post rapid rise in interest rates due to inflation, kind of in keeping with their plan and their trend versus, oh, we have some emergency and that's why we have to cut rates. The second reason for the Fed cutting rates really is, I think it signals the Fed's commitment to overall economic growth. And so as we watch what the Fed's doing, I think we can agree that there's a general trend. It's not rapid. They just did a quarter of a point drop in interest rates, but it's a gradual trend towards that decline. Now, one of the things that I do want to highlight is we have really enjoyed these last few years of high CD rates, high money market rates. We've seen US Treasuries and fixed rate annuities. As the Fed begins to lower rates, we can also perhaps begin to see those types of rates begin to drop as well. So there's some good news in this, but for those of us that are liking those high rates where we can safely save, we do anticipate some gradual moving downward of those rates. What the implications of that for us are, we may want to consider money that is sitting on the sidelines that is not needed for emergencies, that's not needed for day to day. Maybe we want to look at getting interest rates that might lock in for a little bit longer while we're beginning to move into a lowering interest rate environment. This next slide really talks about annual payroll revisions. As I said previously, the Fed has one job, control the supply of money, with two expected outcomes: maintain inflation around that 2% mark, and they want to optimize employment. Well, one of the things that I want to share with this slide is a primary driver of the Fed's decision to lower rates is a softening in the labor market. Before, we had perhaps had, inflation, that was the issue. Here, it's the softening of the labor market. August, only 22,000 jobs were added, which was pretty weak. So the unemployment rate only ticked up to 4.3, but fewer workers seem to be seeking jobs. And so one of the things that the Fed wants to do is to get out in front of that by this move to lower rates. Now, hand in hand with that is people have often said, well, how does this affect overall growth in the economy? We have this thing called GDP, gross domestic product. Gross domestic product is simply the total amount of goods and services produced and ultimately purchased by a population within a band of time, quarterly, semi-annually, or annually. Well, as we see these GDP numbers, 67 to 70% of our economy is driven off of consumer spending. And so as we take a look at the job market and what the Fed is doing, and then how this affects consumer spending, you can see that they go hand in hand. So the Fed is really, I think, trying to get out in front, make sure that we do things that help spur businesses, spur investment, in order to kind of keep that labor market buoyed and strong, because that has a very strong impact on overall spending. So again, rate cuts generally support and benefit businesses and investors. And so that's kind of getting at the why and how what the Fed is doing really moves in sync with GDP and consumer spending. So when this is all said and done, folks, as we take a look at what the Fed's doing, um, it's a balancing act. But as investors, what we want to do is stay balanced. We want to stay in line with our risk tolerance. And so I think the implications for us now is one, don't make any snap decisions or try to time the movement of the Fed based on an investment. I don't interact with folks that do, but every once in a while I'll get asked, "Hey, should I be making this decision with this investment based on the Fed movement?" Again, when and how is far less important than the why. So again, generally the Fed's moving to support economic growth, to support the labor market, and I believe that those things also support a robust, healthy economy with consumer spending. So stay the course. If you have any questions about the implications of these moves and how it might affect your investments, your portfolio, your retirement plan, as always, feel free to call 800-887-9647. Happy to set up a conference call, a Zoom, or a face-to-face to see if there are decisions that might need to be made based on the movement of the Fed in these coming weeks, months, and over the course of 2025 and the balance of 2025 rather, and into 2026. So again, call that number, 800-887-9647. Thanks so much and make it a great day.